Hey there, it's Amy in accounting, and today we're going to go over debits and credits. Debits and credits are the foundation of accounting, but it's not always an easy concept, especially when you're first starting out. So let's try to make this as simple as possible. To begin, debits and credits are used in double entry accounting, which is the method of recording financial transactions where at least two accounts are changed. There is emphasis on at least two because you can have more than two accounts in your journal entry. But there needs to be at a minimum two because you need a debit line that equals your credit line. This is used in accrual accounting, which is the form of accounting most businesses use. Journal entries are your individual records of financial transactions. So if you are working as an accountant, you would be responsible for the journal entries, and at the end of a period, they would be summed up or aggregated to form your financial statements, which show the financial position of a company and are useful internally or externally. A big thing to remember is just that your debits always have to equal your credits. This helps ensure that the accounting equation, assets equals liabilities plus equity, is true and also ensures the accuracy of the financial statements. A big misconception that beginners often have is that a debit means the same thing as an increase and a credit means the same thing as a decrease. But this is incorrect and will lead to a lot of wrong answers. It depends on the account being debited or credited, whether a debit increases the account or a credit increases the account. Another minor thing is that journal entries do not have negative amounts. A minus is implied depending on the debit or the credit and the account. And we'll see more of this in examples further on. So you might be wondering, how am I supposed to remember what accounts increase with a debit and what accounts increase with a credit? Well, there is an acronym called DEALed Girls. DEAL Girls is the most comprehensive acronym I've found that is also easy to remember. There's another one out there, Dealer, which has a similar premise, but it doesn't include things like losses and gains. So DEAL Girls, the first part, deal, these are the financial accounts that increase with a debit. Because it increases with a debit, therefore it decreases with a credit. So DEAL stands for dividends, expenses, assets, and losses. The second part of this acronym is GIRLS, and these are the accounts that increase when you credit it. So if it increases with a credit, then it decreases with a debit. And this is the duality of debits and credits. GIRLS stands for gains, income, revenue, liabilities, and stockholders' equity. So this is a helpful acronym, but another way to think about it is remembering the accounting equation. So in the accounting equation, the left side of it, assets, these are the accounts that increase with a debit. On the right side are your liabilities and stockholders' equity. These are the accounts that increase with a credit. And assets, liabilities, and equity, these are your balance sheet accounts, but on your income statement, you'll have your expenses and your revenue. Expenses increase with a debit, and revenue increases with a credit. And when I was first starting out, another helpful guide is cash. Cash is an asset, and in a lot of your beginner problems on your homework assignments, you will often have cash present. Cash is an asset, so therefore it increases with a debit. And then the other account in your problem would have a credit to it. But obviously, you would still need to make sure that it makes sense, that your journal entry balances and that your debits and credits make sense overall. Some common journal entry conventions are shorthand or abbreviations for debit and credit. Debit is often written as DR and credit is often written as CR. For T-charts and journal entries, your debit will be on the left and your credit will be on the right. So let's dive into some simple examples. So let's say you run a business and you run out of office supplies. So you need more pens and paper. You go to the store and you spend $100 in cash to buy more supplies. Record the journal entry. So let's identify what accounts we would have on your journal entry. So you spent cash, so cash decreased, so that is an asset. The second account is office supplies, which is also an asset. Office supplies increased though because you spent $100 to give it more pens and paper. So, as we remember, assets increase with a debit, decrease with a credit. So here's the journal entry. It's just 2 lines, so you're debiting office supplies for 100 and you're crediting cash for 100. So office supplies went up, so there's a debit. Cash went down, so there's a credit. And this is because they're both asset accounts. And see, we've balanced the journal entry because there's 100 in debit and 100 in credit. So let's move on to another one. So here, you take out a loan of $2,500 for your bank to buy a new espresso machine for your cafe. Record the loan. So here, the two accounts that we would be writing in our journal entry is a loan of $2,500 or $2,500, and you have a new espresso maker, which is equipment. So a loan is a liability, and if we remember deal girls, liabilities are in girls, which are accounts that increase with a credit. Equipment is an asset, therefore it increases with a debit. So here we've taken out a loan, so that means our loan account has increased. So we would be crediting loan payable for $2,500 and we would be debiting equipment for the same amount, $2,500. So here's the journal entry. Debit equipment $2,500, credit loan payable $2,500, and the journal entry balances. So let's move on to the next one. You purchase a table worth $500 from a local furniture store. They offer to let you take the table on credit with payment due within 30 days. Record this transaction. So here, what did we gain? We gained a table. And what other account was affected? This one is actually a little bit tricky, but the account that's impacted is your accounts payable. Accounts payable is the account that records what you owe to other businesses. Accounts payable is a liability, so therefore it increases with a credit. So let's see the journal entry. So the journal entry has a debit to your furniture account, which is an asset, for $500, and there's a credit to accounts payable for 500. So if you've increased your furniture account because you've gotten a table, and then you increase your accounts payable account, which is a liability, for the same amount of 500. So let's see. So you have your cafe has had a slow day and it's sold only 100 cups of coffee for $6 each. So here, record the sale. So this is pretty simple math. So you have 100 cups of coffee and each cup was $6. That means you earned $600 this day. So let's see, what two accounts do we need in our journal entry? The first account would be sales revenue, because you've gained revenue of $600 for this day. But then what is the next account? Let's take a look. You would record sales revenue of 600 and then cash of 600 too. So looking back at Deal Girls, cash is an asset, so it increases with a debit. Sales revenue increases with a credit. So you've gained 600 cash from your customers and you record the same amount in your sales. Those are just a couple examples. I will be posting more. Subscribe if you found this helpful.